Goal number 3 for Chapter 7 is to describe and illustrate the application of internal controls to cash. When we say cash, it includes coins, currency, paper money, dollar bills, $5 bills, checks, and money orders. All of these are considered cash because they're just as liquid as cash and can be used just like cash. Being that it can so easily be used and there's no ownership attached to it as there would be with like a credit card or something, it is the most likely to be stolen or used improperly. That's why we include a lot of cash controls to make sure that we are monitoring the use of it. So where does cash come from? First, customers purchasing products or services. We receive those cash, or even credit card is considered cash, as the customers purchase it, or customers making payments on account. So first we put it on account. When we receive the payment, that's also a source of cash. We control cash through the use of the cash register. The cash register records over-the-counter sales. As you get a printed out receipt, the cash register itself will keep a record of those receipts so that they can be matched against the actual cash received. When we did the journal entry to record cash versus sales, and then we had the cash short and over account, that's what comes up in this comparison of the cash register receipt to the actual physical cash counted in the register. So the cash register helps control cash in a bunch of ways. You'll see first we have the customer gives the cash to the cashier and they put it in the cash register. Then they receive the merchandise and the receipt. And so the receipt is their record in case they need to reference it later, maybe for a return or something. Then from the cash register, the cash gets taken out, counted, and put to the cashier's department in a safe held onto for the cashier's department to handle the transaction. The accounting department gets all of the receipts. So they'll take the receipts and make sure that that matches the actual cash counted. Those receipts then get put into journal entries as the cash received for sales. We've done journal entries like that before. The cash that's given to the cash department is then created into a deposit. The deposit is taken to the bank, and the bank has its records. So you have the bank's records, then you have your journal entries, which are your records. That's where the bank reconciliation comes from. We'll look at that shortly. A predetermined amount of money that is given to each cash register clerk in the cash drawer is called a change fund. So when you first open your drawer, you've got to have some money in there. Maybe somebody buys something for $7 and they give you a $20. You need that $13 to make change. So you have a preset amount in there that's the change fund. So you should have the amount of money for all the sales you made plus whatever the change fund is that started in the drawer. So we have an example here. Cash sales for March 19th totaled $35,690 per the cash register tape. So the cash register says we should have that much money. Then we take out the change fund because that's what wasn't sales, that's just what started in the drawer. And we only had $35,668 on hand. So this is where our cash short and over account is going to come in. Take a second, see if you can remember what we did in class to create that journal entry. Hopefully you remember the entry we did in class. First, you're going to debit cash for the amount that was actually counted in there, the $35,668. That was what was hand. That's what we physically counted. So that's your debit. We're collecting that cash from the sales. You credit your sales for the amount that the sales register recorded. The difference, well, our cash was short. So we have to put that on the same side as cash. So cash and the short add up to our sales. If there had been a cash over, cash short and over would have been credited for the overage. When doing this entry, I suggest doing cash first. It's always going to be the debit. The sales is going to be the credit. Cash short and over will go in the middle, and which side will depend on, is it short or over? When customers pay their bills, we get cash in the mail, and they come with the invoices. An invoice was a bill that we sent to the customer. The customers return usually the bottom part of that bill, and that's called a remittance advice. That's returned with the bill so that the payment can go and get recorded, and then you also have the remittance advice that goes to a separate department so that is proof that that was payment paid. Otherwise, if there was no remittance advice, whoever received the check or the cash could take it and keep it for themselves. So this is one of the internal controls. The remittance advice, the part of the bill that gets sent back with the check, is used to record and check for internal controls. Electronic funds transfers, this is much more popular, like online banking. Customers might authorize that their account pays their bills, their monthly bills in this way. When that's done, there's the electronic record of the bill payment, which helps with internal controls. So controlling cash payments, this should make us feel better or be reassured that A, payments are made for only authorized transactions. As we have these controls set up as we're paying cash as the business, we only are paying for things that are authorized. Also, we want to make sure that cash is used in the right way, for the right purposes, for the right times. So we use a voucher system. It's a set of procedures, a procedural part of internal control for authorizing and recording liabilities and cash payments. And this may be done with physical manual vouchers or just on a computer system. So what is a voucher? It's any document that serves as proof of authority to pay cash or issue an electronic funds transfer. This might be an example at school. We use purchase orders. When I fill it out, Mr. Worley has to sign it in order to approve that. I can't spend any money. Those bills can't be paid unless Mr. Worley has signed and approved that. Our fourth goal is to describe the nature of a bank account and its use in controlling cash. Bank accounts are kept by businesses for a lot of internal control reasons. Some of the things that help are bank accounts reduce the amount of cash on hand. There's less physical cash at the business, at the store, so the employees don't have their hands on it, or a robber couldn't come in and take as much. Also, bank accounts have an independent recording of cash transactions. So you can look at yours and look at the banks and see if maybe somebody has been stealing the money. And it also lets people use EFT, electronic funds transfer systems, to pay. In our electronic environment today, you may lose customers because you don't have the ability to have electronic funds transfers. So having the bank account allows us to be able to do that, gives us an advantage, or helps us keep up with the rest of the companies. So at the end of the month, the bank's going to send you a list of all transactions called a bank statement. We've discussed credit and debit memos briefly in the past. This slide is going to be very important for you. You'll see the company has the asset, which is cash in the bank. So the company, it's actually in the bank here. But we have the asset cash. We have a normal debit balance. Any debits are going to increase it. Any credits are going to decrease it. This is just a normal account for cash, or an asset. So the bank, it's a liability to the bank because the bank is responsible or liable to give us that money back. It's our money. So decreases in liability, that's going to be a debit memo. So EFT payments, service charges, insufficient checks, or bank errors, that's going to decrease our asset. That's a debit memorandum. Balance of the liability account, it's a normal credit balance for the bank. So things that increase the liability are credit memos because it's got a normal credit balance. If it's going to increase the liability, when we deposit money, the bank's going to issue a credit memo. Notes receivable collections, when somebody owes us money and they give it to the bank, that's a increase in the liability for them. It's a credit memo. Loan proceeds, interest earned, bank errors in our favor. It's credit memos that the bank is going to issue because they are crediting that liability, not because we credit it. So when you're looking at credit versus debit memos in bank reconciliations, think of it in terms of the bank, and that money is a liability the bank has to pay back to us because it's our money. There are some memorandum entries that will be found on a bank statement. Here are the abbreviations for such. EC, an error correction. NSF, we discussed previously, not sufficient funds. An SC is a service charge. ACH is an indication of an electronic funds transfer. And MS would be miscellaneous items. This would be a good reference as you are doing your problems to see if these come up, what they mean. Let's take a look at an example problem here. The following items may appear in a bank statement: NSF, or insufficient funds, EFT deposit, service charge, and a bank correction of an error from recording a $400 check as $40. You're going to indicate whether each one would be a debit or credit memorandum on the bank statement and whether it increase or decrease the balance of the company's account. As you're doing this, remember, debit or credit has to deal with the bank and the money as a liability. So a normal balance of a liability is a credit. So if it's going to go up, it's going to be a credit memorandum. If it's going to go down, it's going to be a debit memorandum. Pause, take a second, and see if you can answer this. It's very important that you don't jump forward because you will have items like this on the test. You need to see if you understand it. Let's take a look at the answer. Item number 1 was an insufficient funds check. So is that going to appear as a debit memorandum or a credit memorandum? It's going to appear as a debit memorandum. It decreases the company's bank account because the check was no good. We have to take it out. And to decrease a liability, we debit. So that's why it's a debit memorandum. Item number 2, an electronic funds transfer deposit. That's going to increase the company's bank account. And to increase on a liability, it would be a credit memorandum. Number 3 asked about a service charge. Well, service charge decreases the balance of the bank account. In order to decrease that liability, we debit. So it's a debit memorandum. And 4th, we have a bank correction of an error from recording a $400 check as $40. Well, we recorded it as $400, but it was only supposed to be $40. So to correct that, that's going to decrease the account. To decrease the liability the bank owes to us, we would debit. So it's a debit memorandum. Again, this is very important that you understand how this works. We're going to take a quick look at bank statement. The top of this is the bank statement. The bottom is Power Networking Records. That's the company. This is what we have for a bank reconciliation. Power Networking needs to determine why these two amounts don't match. When they look at their ledger, it shows $2,549.99. But their bank statement when it was sent is $3,359.78. This is where the bank reconciliation comes into play. We've got to adjust the numbers, see where errors might be, and correct that. We'll look more at bank statements tomorrow.